You've sent a payment overseas, expecting it to arrive smoothly, but instead, your recipient gets less money than expected, the transfer takes longer than promised, or unexplained fees show up out of nowhere. So what happened? In many cases, the answer is something you never even see: an intermediary bank. These hidden players often step in during international transfers, and while they keep money moving globally, they can also cause extra fees, delays, and confusion. In this video, we'll break down what intermediary banks actually do, how they affect your international transfers, how much they can cost you, and how to make your next international transfer smoother and more predictable. Let's start with the basics. What exactly is an intermediary bank? An intermediary bank is a third-party institution that helps move money between two banks with no direct connection. When you send money internationally, your bank doesn't always have a direct path to the recipient's bank, especially if it involves a different country or currency. In some situations, your payments may even go through more than one intermediary bank before reaching its final destination. Each additional step can increase processing time and add extra fees charged by those intermediary banks. Think of it like international travel. If there's no direct flight, you'll need a layover, and each stop adds time and cost. Intermediary banks are usually among the largest banks in the world. That's because they need extensive networks, accounts, and relationships across many countries to route payments between the sending bank and the receiving bank. Here are some common examples of intermediary banks. Because of their size and global reach, these banks are often used to connect payments involving smaller banks that don't have direct relationship with each other. They're also commonly involved when a payment is sent through the SWIFT network. SWIFT is a secure messaging system used by banks worldwide to exchange information about financial transactions. How does an intermediary bank work? Here's how it works. Alex in the US, that's Bank A, wants to send $1,000 to Jamie abroad, Bank C. But here's the catch. Since their banks don't have a direct connection, Bank B steps in as an intermediary. So first, Bank A sends a payment instruction for $1,000 to Bank B. Then, Bank B processes the instruction, applies a $20 fee, and forwards an instruction for $980 to Bank C. Bank C receives the final instruction, and after settlement between the banks, credits Jamie's account with $980. Now, if Alex wants Jamie to get the full $1,000, Alex will need to send more than $1,000 upfront to cover that intermediary fee. How much are intermediary bank fees? Each intermediary bank charges its own handling fee. The challenge is that when you initiate an international transfer, you usually do not know how many intermediary banks will be involved, which banks they are, or how much each one will charge. On average, intermediary bank fees range from $15 to $30 per bank. When a transfer passes through multiple intermediary banks, those fees can add up quickly, on top of what the sending and receiving banks already charge. Other than the number of intermediary banks involved, other factors that influence how high fees are include the countries the payment passes through, the currencies being exchanged, and the total transfer amount. For example, major currencies like US dollars, euros, and British pounds tend to come with lower intermediary fees. Less commonly used currencies often require more routing, which usually means higher costs. Here's a useful tip. If you're sending money through the SWIFT network and wants to see what happened to your payments along the way, you can ask your bank for MT103 document. The MT103 document shows the payment route, the banks involved, and where fees may have been deducted. Just keep in mind that some banks charge an additional fee to provide this document. Who pays for intermediary bank fees? When you send money internationally, intermediary bank fees do not always work the same way. Either the sender, the recipient, or both can end up paying these fees. Who pays depends on the details of charges you select when setting up the transfer. There are three standard options. First is Our option. With Our, the sender covers all fees related to the transfer. This includes fees charged by the sending bank, the receiving bank, and any intermediary bank involved along the way. Because banks do not know in advance how many intermediary banks will handle the payments, they usually charge a fixed upfront fee based on average costs. This is typically around $60 to $70 added on top of the transfer amount. For example, if you send $1,000, your account may be debited $1,070, while the recipient received the full $1,000. This option is especially useful when paying suppliers because it helps ensure the amount received stay the same or very close to what was sent. Next is the SHA option, which stands for shared costs. With SHA, the fees are split between the sender and the recipient. The sender pays their own bank fees, which are usually around $15 to $30. The recipient then pays the receiving bank and intermediary bank fees. These fees are often deducted from the transfer itself. which means the recipient ends up receiving less than the amount originally sent. Finally, there is the BEN option, where the beneficiary pays. On the BEN, the recipient covers all fees, including intermediary bank fees and receiving bank charges. The sender does not pay any transfer fees at all. As a result, this option creates the largest difference between the amount sent and the amount received, since all costs are deducted before the fund reaches the beneficiary. Intermediary banks play an important role in making cross-border payments possible, but they can also introduce higher costs, delays, and uncertainty, possibly being the reason your international transfer did not arrive in full. By understanding how intermediary banks work and being more intentional about how you send international payments, you can reduce surprises and make sure your money reaches its destination as expected. With Statrys, businesses can benefit from fixed and transparent SWIFT fees when international wires are required, along with real-time tracking that shows where payments are throughout the transfer process. Alternatively, Statrys also offers local payout options, allowing businesses to send funds through local networks for lower fees, faster delivery, and full amounts reaching recipients. This added visibility and flexibility help make cross-border payments more predictable. If you want a clearer and more controlled way to send international payments, visit statrys.com to learn more. Thanks for watching.